Federal Reserve just raised interest rates a quarter point.
Yes, up again. So real estate loan officer Mark Goldman here to talk about how this affects mortgage rates. Good morning, Mark. An important discussion to have here.
Yeah.
Everybody cares. Good morning.
Yes,
Good morning.
Thanks for joining us. So we want to talk about how the Fed rate now increase affects mortgage rates. So many people
Good question.
wanting to borrow money.
The Fed rate that was raised tomorrow, I call it a 12-hour interest rate. Okay. So it doesn't really have a big impact on 30-year fixed rate loans. Okay. It will change people's interest rate if they have a home equity line of credit that's tied to prime rate. Because when the Fed raises its overnight rate, the prime rate goes exactly with that typically, and most home equity lines are tied to prime rate. So for second mortgages, yes, it's going to raise the rate. Okay. Actually, as was typical yesterday when the Fed announced their rate hike, we actually got price improvements on 30-year. Why? Because the market anticipated the quarter point. So that was already cooked into the rates. And when the Fed actually did it, everybody had a sigh of relief. Oh, it wasn't worse. You know, they could have raised it half a point or so. So rates actually backed off, and there's a little bit of follow through on that this morning. The mortgage-backed bonds are even a little bit better this morning than yesterday.
Okay, so for folks that are at home right now considering buying a house, is now a good time to buy in San Diego? Is that an easy question to answer?
In my opinion, yes, and I will tell you why. What's been going on in the housing market? Prices have been depressed, but what's pushing prices down? High interest rates. Our job market's quite strong, household incomes are going up, supply is quite limited, demand is super strong, there's very limited inventory. So those are all factors that push prices of homes up. So what's been pushing prices down? Higher interest rate, a higher cost to own the house. What will happen if rates go down? Prices are going to come back up. So you hear the expression, you know, love the home, date the interest rate, you know, because if for people who buy now, I do expect we'll return to trend. And, you know, a lot of neighborhoods, if you look at Zillow or if you get a HomeBot report or something like that, a lot of neighborhoods are showing kind of a dip in the price of homes in your neighborhood. But we're already seeing recovery in a lot of neighborhoods. So there's a trend line, but you know, you get the dip, but then the house gets back on that trend line. So I
mean, Mark, we've been looking for years, right, to try to buy a home. People that have decent jobs are making decent salaries, working hard.
Are you sorry you waited?
It's so hard to do.
But are you sorry you waited?
Of course. I mean, you see what people bought these homes for 5 years ago, and then now, whew. So it's wild. It seems impossible.
It's you know, we see all the time people who are buying their first home, for example, and they are just stretching to get into that home. But when you talk to them 1, 2, 5 years later, you know, they're really, and they don't remember the stress.
The struggle and stress. So keep looking to see what might work for you.
And there are other loan options available, not just 30-year fixed rate. What are some of the advantages and disadvantages for people considering?
Well, you know, it's kind of odd. Right now, typically the lowest interest rate loan most people are going to get is going to be a fixed 30-year loan. A lot of times the loans, there are loans that are interest only. There are loans that have adjustable rates, or they're called intermediate adjustable rates. They're fixed for the first 3, 5, 7, or 10 years of the loan, but they're 30-year loans. But when you're done, there's adjustments to pricing based on credit scores, loan to value, type of property, and so forth. And when you do those adjustments, usually you land on a 30-year fixed rate.
Okay. All right, Mark Goldman, thank you for joining us this morning.
Pleasure to be here.
Good to get your insight.